No sé, creo que puede ser muy bien, pero depende. Entonces, espero. How are you today? Do you start exams this week? Yes, you do. You started last Saturday? On Saturday?
When we were Saturday, Friday.
That's the reason you didn't come, or?
Maybe. No, I came.
You just didn't come, so that's the reason you didn't come?
Maybe. I don't know.
And how did you go? How did you go? Done? Okay. Enough. What was the new content we started on Friday? Leasing. And what is a lease?
Teacher, I think
What was the problem? Okay, go ahead.
It's a type of rent.
It's a type of rent. It is a rent, yes. It's a, what do you say? Arrendamiento in Spanish, yes. It is a commitment in this.
it's a way to buy an asset for cheaper. Alternative.
It's an alternative to buy, yes, because you may not buy it in the end, right? Maybe optional. Exactly. Okay. So let's give a quick review before we do exercise. How many weeks do we have left? 4, including this one?
5.
5, including this one. Wow. Good, okay. So how many parties are there in a lease agreement? 2. Which are called? Correct. Then we see. Then this one. And how do we call the lessee if it is a real estate lease agreement? Tenant. Good. How do we call the lessor in a real estate? Landlord. Right. Excellent. You are great. You are paying attention. So we call lease payments in a simple way. How? A simpler term for lease payments would be a simpler word.
Rent.
Rent. We usually call rent what in a financial terminology would be called lease payment. Okay? So far so good? So lease is an alternative to buying an asset. 3 types of lease agreements that we review: the sale and lease back, the operating, and the financial lease. What is the difference between the 2 and the 3rd type? The 2nd and the 3rd one. What is the difference between an operating or service lease and a financial or capital lease? What is the main difference? Go ahead,
In the financial lease, you can own at the end of the lease.
right? You will have the option to buy the asset at something that is called bargain price. Great. Okay.
And in the financial, you also the risk on the things.
Yes, yes. The risks and the rewards, yes. And the sale and lease back is very specific for what type of sector? Real estate. And how many contracts are there in that agreement? 2 agreements, 2 contracts simultaneously at the same time, right? One for the sale and purchase of the property and another for the leasing of the property. Okay, very good, excellent. So 4 criteria that we analyze, we evaluate in order to determine in accounting terms if the lease agreement is a financial or a financial lease or an operating lease. I have to say this. These rules do exist. We are going to review them and we're going to do the exercises according to these rules. But I have to let you know that as from 2016 and effective 2018 and 19, in the United States, any lease agreement which is over 1 year long, it has to be treated as a financial lease. Okay, so they changed a little bit because companies were deceiving shareholders, but for the purpose of the exercises in the class, we will keep the criteria and we need at least one of these 4 to be met so that we can classify the lease as a financial lease and then treat the lease in financial and accounting terms accordingly. Okay. So just to review, the second criterion refers to the bargain price. If the asset may be bought at a bargain price at the end of the lease agreement, then the lease should be treated as financial. And the definition for bargain is not really very clear in the law, but for practical purposes, anything that has a 30% discount or more up to $1, because you have to pay something, okay? It cannot be 0. That would be a bargain price. In the law, it says it has to be a price substantially lower to the market price. What is substantially lower is not defined, okay? So for practical terms, we use, or the market uses, this 30% discount. Now, for criterion number 4, in order to determine the present value of the lease payments, we should be at least 90% of the assets value, market value, to be for the lease agreement to be classified as financial. We use the rents. Okay. If in the rent the maintenance is included, we have to deduct it first. And if there is a bargain price, there is a debate whether we should include it or not, but to be clear in the class and not to give you any confusion, we won't include, which is probably more common, we won't include bargain prices in the lease payments, okay, for the calculation of the present value of the lease agreement. Okay? That should be important for you to take notes, okay, so that you remember that. All right, so far so good. So let's practice that before we review the bookkeeping. Have an exercise where we have to classify this agreement whether operating or financial. But you have to fundament the recommendation based on the 4 criteria of the 5, okay? So the example is a photocopier that costs $3,500 if it were purchased new. The lessor is willing to lease the copier to you for 3 years, starting in 2015, so it doesn't matter the year. The price or the rent per month is $115. You have to pay that price at the beginning of each month. And 16 out of these $115 are identified as the cost of maintenance of the equipment. And I'm going to give you a couple of minutes so that you can take notes, particularly about the figures that you see on the board. Yes.
The cost of maintenance is per month?
Yes, per month. Included in the rent, yes. Okay. There's more information, okay? You got what you need?
Yes.
Okay, that's it. So it continues. If the company borrowed money for 3 years to finance the purchase of the photocopier, the interest that you have to pay is 8.5%. If the company bought the photocopier in cash, they would depreciate the equipment over 5 years in a straight line. The lease agreement has the option to buy the photocopier at the end of the lease for $500, which is estimated to be its fair market value at that time. And the question we have to answer is this an operating lease agreement or is it a capital lease agreement?
Financial.
Yeah, capital or financial, operating or capital.
Financial.
We have to prove it. We have to assess each of the 4 5 criteria and determine whether criterion 1 is met or not and why. Whether criterion 2 is met or not and why, and 3 and 4. And then conclusion, right? Okay, is it clear? So if it is capital, we have to prove it. Anyone remember past criterion number 1? What is it about? Ownership, yes. Criterion 1 states that the lessee transfers the ownership of the asset before the maturity of the lease agreement. So becomes the owner of the asset, in other words. Does this company become the owner of the photocopier before the expiration of the lease agreement?
No.
It has an option to buy it, but that's different. Transfer of ownership is I get it. It's given to me, right? I have to pay for that. That is to pay a bargain price, and that's a different criteria. Okay? So criteria number 1 is not met because we do not have any evidence information that can accuse us, that the ownership is transferred to the lessee. Clear? What is criteria number 2? Did you remember? The lessee may buy the asset at the end of the lease agreement at a bargain price. Is the criteria met or not this time for this example?
No, I think no.
No, why not?
It's 500, maybe it's not, a bargain price for the depreciation of the 5 years.
Because you said that for a bargain price, the maximum, it will be the 30% of the value of the asset.
30% discount, 70% of the market value, right? And?
It says the depreciation per year, I think is 700. So,
Why are you using depreciation with that criterion? I do not understand.
I use it because I think we have to depreciate to have the real value.
Now, but that would be the savage value, book value. We have to compare the bargain price to the market price of the asset.
Okay.
Depreciation will give us book value. Mauricio?
Yes, because where it says that 500, which is estimated to be a fair market price. So if it's a fair market price, it won't be a bargain price. So the criteria is not accomplished.
What percentage of the market price of the photocopier would the company pay in the bargain in this price? 100%. So there is no discount. The market value of the photocopier at the end of the lease will be $500. The company would have to pay $500. So compared to the market price, this bargain price, which is not a bargain price, would be 100% of the market value. It has to be 70% the most. Right?
Yes.
Yes.
If the fair market price is not many, but we consider the salvage.
Yeah, then we will have to consider that. Exactly. Yes. In that case, yes. Okay. So criteria number 2 is not met. Purchase price, I'm going to call it purchase price because we know it's not a market price. So purchase price at the end of lease is 100% of market value, right? Market price. Yes?
Yes.
So we deliver the conclusion, we deliver the assessment and the reason. Okay? The reasoning. So far, so good?
Yes.
So criteria number 3 is about
The duration.
the maturity of the lease agreement. for the agreement to be classified as capital or financial, the lease agreement should last at least 75% of the useful life of the equipment, of the asset. So how long is the lease agreement?
3 years.
And how long is the useful life of the,
5.
we have to assume that it is 5 because of the depreciation information. So 3 out of 5 is,
6.
is it met?
No.
Not met. Because the lease agreement about 67%, right? You told me? Approximately 67% of useful life of assets. Or assets useful life. So I have to write less. Okay? Assessment and reason. So our only hope is that criterion number 4 is met. Otherwise, this will be operating, right? Do we agree on that? So criterion number 4 refers to of the lease payments, of the rents. So we need to calculate the present value of the lease payments.
Because the value of
Yes, that's right. So we will estimate the present value of an annual. Right. So the present value of lease payments is the present value of an annuity. So we need to know what is the amount of the annuity. What is the value of the annuity? Sorry, can you repeat that?
Discount the maintenance amount that is 16 from the 150.
Okay. So 115 minus 16 equals $99 per month.
Yes.
So we already know that to calculate a present value, we need cash flow, we need time, and we need discount rates, right? So we need time and we need discount rates. Time equals 36 months.
Yes.
Okay. Discount rate?
Would I use the 8.5 as a reference? So
We have to.
In annual terms, that is the discount rate. It is the before tax cost of debt for the lessee. That is the discount rate for the estimation of the present value of lease payments. The before tax interest rate, cost of debt for the lessee. 8.5 is the before tax cost of debt for the lessee. But that is, we know that if they don't tell us, that is an annual interest rate. And we need a monthly interest rate.
it's
We can make 2 assumptions. Assumption 1, the 8.5% is compounded monthly. That's one assumption. The other, the 8.5% is an effective rate. What do you think is most likely to be the correct one and why? Correct assumption. Which assumption would be closer to the reality and why? The first one, why?
Because we never built the effective.
Because if this were a loan, the company would pay monthly, and therefore the interest rate would capitalize monthly. Okay, so we would follow this assumption. Very well. So, okay. And yes, indeed, the interest rates that are reported, that are disclosed are nominal. Yes, remember? So, how do we transform the 8.5% annual interest rate to the monthly interest rate we need?
It will be just the 8.5 divided by 12. It will give us 0.007083.
70?
7083.
83?
Yes.
Like this?
Yes.
Yes. So 0.7%?
Yes.
But remember that because the interest rate is compounded monthly, and we are looking for an effective rate in monthly terms, the effective rate formula simplifies to a division, right? In order to transform nominal rates into effective rates, we always have to follow the equation of the effective rate. Okay, so because n equals 12, n equals 1/12, then the whole equation simplifies to the annual rate divided by 12. Okay? Well, we have to keep on using that equation all the time. Okay, so we have cash flows, we have time, and we have discount rates. Do you remember the equation for the present value given an annuity? Annuity times.
Times and 1 plus R.
I'm using I, so but you are correct. Like this. Substitute the values and give me the present value of the lease payments, please.
I think it's 139.76 annual.
Dollars?
Annual wrong, yes.
It's too little, isn't it?
I get 3,136.13.
Point what, sorry?
133.
I think I missed it on the interest rate.
This one. Yeah, because if we have payments of about $100 per month for 3 years, and the present value is 100, it doesn't make sense, right? Double check, let me know if 3,136 is correct, please. Yeah, you got the same? Okay, so the criterion states if the present value of the lease payment is at least 90% of the market value price of that asset, then the lease should be classified as financial. What is the market price to which we have to compare these 3,000?
3,500.
That's correct. It is the market value at the beginning of the lease, okay, not at the end. So 3,136 over 3,500, is it?
For me, it was 89%, 89.60.
Just about. Is it capital or not? Strictly speaking, it is not. 89.6 is not 90. 69.9 is not 70, right?
It should.
It should be. So criteria number 4 is not met. The present value of the lease payments is lower than 90% of the market value of the asset. Or price, right? The asset in this case is the photocopier, right? So none of the four criteria is met. Therefore, this agreement is an operating lease.
Teacher,
Yes.
we only consider rents, anything about from expenses and market price?
No, just the monthly payments or the periodical payment.
Okay.
That is the convention we will follow in the class. Okay?
So for point two, we use the market price at the end,
Yes.
and for point four, we use the first one.
Because in criterion 2, we compared the bargain price, which is at the end, with the final price of the asset. In the criterion number 4, we compare the present value of all the lease agreement at the beginning. So we compare it with the initial market value of the asset. Good observation, Elizabeth. Let me close the door in case distracted.
So guarantee should always consider the maintenance.
If in the monthly or periodical payment, there is maintenance included, you should deduct it. But if it is not included, then there's nothing to deduct. Sometimes you pay the rent and the maintenance is aside the rent. Right? So it depends. If it is included, we have to deduct it. Otherwise, there's nothing to deduct.
And if the maintenance will per year instead of monthly, we have to take the present value of that maintenance.
Yes.
And
Yes, exactly. We will have then a cash flow which are monthly, and then in some years, you will have maintenance, so you have to deduct this from the person value. Okay, yeah. It was the same question. Any other question? So what have we done? We have assessed the information about a lease agreement to determine whether it is operating or capital. Okay, that's what we have done so far. What's next? Once we classify the agreement as operating or capital, then we do the bookkeeping and we do the valuation. Okay, so let's review the bookkeeping. No questions?
No.
Okay. So once we classify the agreements, we have to keep in mind the following. Operating leases, from the lessee point of view, do not give the property of the assets to the lessee. Therefore, what the company can do for operating leases is to deduct from taxes the lease payment, the rent. It will go direct to the income statement as an operating expense. Okay, rent for the building, the rent for the machines, the rent for the cars, the rent for whatever asset the company is not buying, but is financing through a lease agreement. Okay. Because in the income statement, we only include the current period, so from January to December, or from the 1st January to the 31st of January, we do not include the cash flows, the payment we will make in the second year, or the third year, or the second, third, fifth month. We have to disclose it as a contingent liability. So we calculate the present value of all the commitments. In that case, apart from the rent, we would include any bargain price or any other cost that is associated with the lease agreement, and we would put it as a note to the balance sheet and the income statement. Okay? But in the financial lease, it is as if the company were the owner of the asset. So it could go in the balance sheet under assets. We would have to record the liability on the liabilities side because we will alter the balance, okay? And because we will record the asset as one of our fixed assets, then we can depreciate it. But because the company can depreciate the value of the asset, they cannot deduct the tax, the lease payment, because they would double the cost. You see? If you sum all the depreciation expenses over the life of the lease agreement, that would sum the value of the asset. If you deduct, and on top of that, if you deducted the rent during the life of the lease agreement, you would be doubling the value of the asset. So it is as if you were paying twice, and you would deduct twice as well. So it's not fair. So either you deduct the rent in the operating, or you deduct depreciation. You cannot deduct both at the same time. Okay? And because depreciation would add up to the value of the asset, but in fact, you will be paid more than that, because you won't rent for the same value of the asset. You will pay the value of the asset plus some service, which is an interest, which is implicit in the rent. So when you register the asset under the fixed assets in the balance sheet because you have a capital lease, you can depreciate it. Depreciation will be deducted from taxes. You can also deduct from taxes the interest you are paying in the rent. So maybe in the previous example, in this $115, 16 are maintenance, but probably here are $7, which are interest. Those $7 would go in the interest expense of the income statement on top of depreciation. So if you add depreciation plus interest, then you get the whole expense of the cash flows of the lease. Okay? Is that more or less clear?
Yes.
So that's the bookkeeping. Operating leases are an expense. Financial leases are a purchase like of an asset. You can depreciate it and you can deduct interest implicit in your rent. Okay? Still, you have to pay the rent. Do you see the difference? I'm going to pay $115 as a rent for this photocopier every month. Because it is operating in this case, $115 will be automatically deducted from taxes every month. But in the case of this example that we will do later, the photocopier is depreciated over 5 years. I can only deduct from taxes every month the proportion of the depreciation per month, if it were capital. So in other words, operating leases allow the company, allow the lessee to deduct more quickly the expense they are incurring, because it goes directly to the income statement as an expense. Right? Depreciation is usually longer than the maturity of the lease agreement, which makes capital leases more slow to deduct the expense. Of course, there is an advantage. There is a huge difference. In the capital lease, I have the option of becoming the owner of the asset. In the operating, I will never become an owner. So I don't have that upside at the end. Think of a house. There are people who rent houses for 40 years or more. All their lives, they are renting houses. So imagine that situation. For 30 years, you were renting a house. At the end of the 30 years, you have nothing. At least in terms of real estate, right? Someone who asks for a credit to get the house, after 30 years of paying monthly the credit, they end up having an asset worth probably some $100,000 or probably $1,000,000 pesos, right? So that difference in terms of wealth is huge. You see the difference? So maybe at some point an operating lease seems cheaper. But if you look at the cash flow for 1 month only, you are not looking at the whole picture. And you should be looking at the whole picture. Valuation is not just looking at the income and outcomes of cash flows. Valuation is about wealth. It's not about cash flows. Okay? So that's why we have to value the decision. We have to value the lease agreement as a whole, not just looking at the expense of 1 month. Is that clear what I'm saying? So there are differences, yes, but you have to look at the whole picture. Maybe you are not interested in owning a house. Maybe you are not. Or maybe you are not interested in owning a car. And you are happy to spend money every month for the whole of your life. That's the risk tolerance or the risk aversion of each of us. That's why we make different decisions, because we have different expectations, right? All right, so far so good?
Yes.
Good. So that's it. So for valuation, which is usually represented as present value, we need cash flow. So what cash flows are we going to use for operating? No, this is first buying, for the buying option. Let me bring a table. So it's not the example we did, but just to give you an idea of what the cash flow table will look like. We will have the cost of the equipment as a negative cash flow. If I buy on cash the asset, then I have to pay upfront the market price of the asset, okay, times 0. I'm going to use the asset, of course, that's the reason we are buying it. We are comparing buying with leasing. So in the buy option, I have to pay the maintenance. It's an independent expense, right? So every year I will be making expenses related to the maintenance of the equipment. Maintenance is an operating cost. And in the income statement, anything that is a cost is tax deductible. Okay, let me visualize this. So we have revenues minus cost of goods sold equals gross profit, yes?
Yes.
Minus operating expenses, which include what? Usually depreciation. What else? Amortization, of course.
Salaries?
Salaries, yes, for administrative expenses. Selling expenses. Rents is usually part of an administrative expense. So maintenance costs, if they refer to the assets with are directly related to the sales, will go as a general cost here. Otherwise, it will go as an administrative expense, right? So maintenance costs will be either over here or here, depending on what type of asset we are assessing. Is it an asset for operation over here? Is it an asset for the administration over here, right? So gross profit minus operating expenses equals? Correct. Operating profit or earnings before interest and taxes minus financial costs, let's say interest costs. interest expenses equals before earnings before taxes, right? Before taxes minus taxes, net earnings. Sorry, I ran out of space. There it is. What happens if I deduct $100? Let's say I have $1,000 of revenue. Forget about the rest. I just want to make the point of the tax sheet. So what if I deduct $100 and I get EBIT of $900? Let's say taxes are 30% of the earnings before taxes. How much taxes am I going to pay?
The 900? Yes.
So zero interest rate,
270.
270, right? And my net earnings will be?
630.
If the company did not have this expense, if the company did not have the maintenance expense, then earnings before taxes would be 1,000. Do you agree?
Yes.
And the company would need to pay $300 in taxes, right? What is the saving in taxes that the company is realizing because they are allowed to deduct these maintenance costs? $30. And $30 happens to be 30% times the cost, the deductible cost. Am I right?
Yes.
And that we call tax shield. Okay. All right. So we call tax shield the saving in taxes due to the deductibility of an expense. All right? What if the company could deduct $200 of depreciation of an asset? What would the saving in taxes be due to the depreciation expense?
60%. $60.
$60. So tax shield equals the corporate tax rate times the expense. Amount of the expense, right? No. Depreciation is not a cash flow, but the saving in taxes is. Okay? So the same way the maintenance cost is a cash flow, it's a negative cash flow because I have to spend that money. I can save because I can deduct maintenance cost. There is a tax shield on depreciation. Depreciation is not a cash flow. You see, it's not in my table. But the tax shield due to the depreciation is. Okay? So among the cash flows that we will include in the buy option, so that we can compare it to the lease option, apart from the cost of the equipment, from the maintenance or any other operating cost of the asset, the tax shield due to those maintenance costs, we have to include the tax shield of the depreciation, because when we buy an asset, it will be reported as one asset in the balance sheet of the company. We can depreciate it, and that will save us in taxes. Okay? And that's what we call the tax shield. So tax shields are positive cash flows. Did you notice? Yeah. The maintenance cost, the expense because of the maintenance of the photocopier is a negative cash flow. The purchase of the asset is a negative cash flow. But all the savings relevant to the expenses I can deduct will be a positive cash flow. Okay? So usually maintenance costs are cash flows in arrears at the end of the year, So at the end of the year, I will have the tax shield because of that expense. Depreciation will be saved in the following period. So I buy it today, I will be able to deduct depreciation next year. Okay? So after identifying the cash flows that are relevant for the buy option, we calculate the net cash flow of the buy option. So we sum all the cash flows for all the years that are relevant for the purchase of the asset. If I bought the photocopier, it would last 5 years, not 3. Because the useful life of the photocopier of the exercise we did before is 5 years. 3 years is the length of the lease agreement. It does not mean that if I buy the photocopier, I can only use it for 3 years. No, it will last. It will be useful for 5 years. Okay, so in the buy option, the period of time corresponds to the useful life of the machine, of the asset, because I am buying it. It's mine. It will be mine until I decide to sell it. Of course, I can decide to sell the photocopier after 3 years. Yes, I can decide that. Okay? But I have an asset that is useful for 5 years. So far, so good?
Yes.
Okay. So if it were an operating lease, which are the cash flows that we need to use? For the operating lease agreement, we are renting the asset. We do not have a cost of equipment cash flow because we are not buying it. Okay? But we do have the lease payments. And lease payments are usually cash flows in advance. So this cash flow, which is a negative cash flow in year 0, is the rent for the first year. And this is the rent for the second, etc. So we have a 7-year time horizon, and the 7 payments go from 0 to 6, not from 1 to 7. Why? Because those are cash flows in advance, yes.
When we did the exercise, like we didn't deduct like the, since it is adelantado, I remember in Corpo when we wrote that in adelantado we had to multiply -1 over the.
Yes, you are right. We did not do that. We should have, yes. Did you understand what Emmanuel is saying?
Yes.
So we deducted $99 in the photocopier. $99 for 36 months. And when we estimated the present value of the annuity like this, this is the present value of an annuity for cash flows in arrears. Very well. Very well. Excellent. So, what do we have to do to calculate correctly the present value of the lease payments of the photocopier? Because in the description, if I am not wrong, they mentioned that it is paid in advance, right?
Yes.
It's starting paid at the beginning of each month. So maybe it will be capital. So what do we do?
the annuity loss.
What was the interest rate? Can you remind me?
25%.
But monthly?
No, 8. No. 0.7? 783.
0.07083.
No, right.
Like this? Okay. So what do we need to do to make this annuity an annuity in advance? So this present value is as if the monthly payments of the lease agreement were like this, starting in month 1, but they will start in month 0, right? So instead of having from 1 to 36, we will have $99 from month 0 to month 35. What do we do?
99. The present value of an annuity followed by 35 here.
So you want me to change the quotes? Well, that could be one. Okay. So we could calculate the present value of 35 monthly payments plus one more, which is not discounted. And if I wanted to keep the 36 as the quotes, what would I need to do?
Multiply by the discount.
Right.
1 over 1 plus the
Interest rate.
interest rate.
Have you redone the numbers? Is it over 90 this one? So if I use the prudence of 36, I would have the black cash flows discounted, right? It would be as if I started here and finished here, and my present value would be 1 month before today, or 1 month before the real beginning. So I would need to discount or to multiply. Are you following me?
Yes.
The red cash flows are the realized cash flows. So I have one starting right now, and the last one ended in month 35. If I assume or if I use the equation assuming they were cash flows in arrears, then my present value would be 1 month before 0. So last month, right? And I want a present value here. I need to compound it, not to discount it. Do you agree? I need to compound it. I think you told me the other way around. Or maybe I misunderstood. Right? I multiply it. Cash flows in advance should be more valuable than cash flows in arrears, all other things equal. Learn this by heart. Cash flows in advance are more valuable than cash flows in arrears, all other things equal. If I divide instead of multiplying, it will be lower, not higher. So what I'm trying to tell you is, you don't have to learn this by heart, but if you follow the logic, you will find the equation. I prefer that you follow the logic, that you learn the logic, because the question should come, you know. If you learn that you have to divide or you have to multiply, but you do not understand why, you will forget it, or probably you will mix it. But if you learn the logic, if you learn the concept, a cash flow in advance is received earlier than a cash flow in arrears. So we should be worth more in advance or in arrears? In advance. So all of the things equal, an annuity series in advance should be more valuable. You have a higher value, in other words, than a series in arrears. So I cannot divide, I should multiply. That's like my logic, right? I'm not good at remembering things, but I'm good at understanding the logic and then deducting formula. That's how I work. That's how my mind works. Maybe some of you can follow that or have the same profile. Okay. I don't have space in my mind to remember all the formula I wanted. I don't have space. I just don't have space. Okay, so I need to follow the logic. It's easier. All right, so far so good. So what is the present value, Ben? It was 3,100 something. Is it now 3,000 what?
3,158.
158?
0.3472.
And is it enough to reach the 90%
Yes,
threshold?
it's 90.24%.
90.24%? Okay. So this could be capital, not operating. Thank you, Manuel, for reminding us. Did you get the same? Like the 3,150? Okay, excellent. Okay. So please make the correction. Criteria number 4 is met because the present value of the lease payments is greater than 90% of the market value of the asset. Therefore, the lease agreement for the copier is a capital lease. Okay? We should capitalize the asset, which means we should record as a fixed asset and we should depreciate it. Okay? Okay. So let's go back to the cash flows of the operating lease, shall we? Or is there any question? No? Okay. Let's go back. So cash flows for the operating lease, the lease payments, which are cash flows in arrears, negative. Okay. In an operating lease, the rent of the asset, if it is an operating asset, would go in the cost of goods sold. If it is an administrative asset, would go in the administrative expenses. Wherever it goes, it could create a tax shield because we would deduct just as we did for the interest, also for the rent and for the depreciation here. We would deduct the lease payment. We would have a tax shield. The tax shield occurs in the same year of the expense. That's something important. The tax shield occurs, except for the depreciation, the tax shield occurs in the same year of the expense. The same year of the expense, the following year of the capital expense. Okay? The same year of the operating expense, the following year for the capital expense. Capital expenses are investments. Okay? So this is a capital investment. The tax shield for this is 1 year after. You see the difference? This is an operating expense. The tax shield goes in the same year, in the contemporary year. Okay? Is that clear what I said? No? So what else do we have in the operating lease? Apart from the lease payment and its tax shield, we will have the maintenance cost and the tax shield of the maintenance cost. Because whether we rent the car or whether we rent the photocopier or we buy it, we have to maintain it. Okay? That does not change. So as you see, if I take this cash flow or this one first, whichever you prefer, and you deduct one from the other, maintenance costs and the tax shield will compensate. So sometimes we don't use it. We don't use it if the objective is only deciding whether one is more expensive than the other. But if I want to calculate the cost that we are incurring to present it to a group of people, then I cannot ignore it. I repeat, sometimes I will ignore maintenance cost and its tax shield because the objective is only deciding which of the two alternatives is more expensive. Okay, but if I want to present to the board of directors how much money we are spending in these leasing agreements we have, I cannot ignore the operating expense, even the maintenance cost, even if it is the same as in the buy option. Okay, right? When we do an exercise, probably I will be clearer on that. Okay, so far so good. Cash flows of operating lease, that's probably the easiest of the three. And then, in order to determine whether, for example, an operating lease is more expensive than the buying option or the other way around, what we do is to value the incremental cash flow. Do you remember incremental present value that we reviewed last semester? We had two machines. Each machine had cash flow, and we deducted one from the other, right? The cheaper from the more expensive. And that incremental cash flow vector, we use it to calculate present value, which we call incremental present value. And we decided whether to buy the cheaper or the expensive, depending on the sign of the present value. Quite similar is here. But in this case, we always take first the lease cash flows. It is always lease option minus buy option. We don't care which one has greater cash flow in year zero. What we do care is which one is the lease and which one is the buy option. So the incremental cash flows for valuing a lease agreement always take first the cash flows of the lease, and we deduct from those the cash flows of the buy option. So it's always lease minus buy, lease minus buy. So this is my table from the lease option. And this is the table I had before. This is the table for the buy option. So it's exactly the same cash flows, okay? They are just together in one slide here, this time. What do? We have net cash flows for the lease agreement, this line, and we have a line for the net cash flows for the buy option. What we will do to estimate the incremental cash flows is we take the net cash flow of the lease minus the net cash flow of the buy. So minus 10.99 minus 100. Where do we get? A positive 89. Okay, and then minus 18 minus 2.8. Where do we get? Minus 15.99. And so on every year. And this line is the incremental cash flow of the lease agreement. Okay?
Yes.
We can create separate tables, estimate the net cash flow of each option, and then make the difference. Or we could, probably at a later stage, in one table, mix all of the cash flows of the buy and the lease option together. That's probably more confusing than the other option, okay? But you have both, whichever you prefer. Okay, I think this one is clearer and takes you to a fewer number of mistakes at the beginning, at least from the beginning, in earlier stages. But of course, at the end, we can prepare only one table and get one cash flow. Okay, the difference between the two. So what do we do with the incremental cash flows of the lease option minus the buy option? We estimate that present value. If the present value is positive, the lease option is more valuable than the buy option. and we do lease the asset. Otherwise, we have to buy it because that's the best option. Okay? So far, so good? What if on Wednesday we do exercises of valuation? Let me just tell you what we would do if it were a financial lease, which is the case of the photocopier. We are going to value the photocopier on Wednesday. For the financial lease, we still have the lease payments. They are cash flows. They cannot be deducted from taxes, so I don't have a tax shield for the lease payments. But I have to spend the money. Okay, so I do have the expense of the lease payment, starting from zero because they're usually in advance. In a lease payment, remember, I capitalize the asset. It is one of my fixed assets. I can depreciate it. Therefore, I have the tax shield of the depreciation of the asset, starting in year one. Okay, and then I have a tax shield of the implicit interest. What if I have here, instead of this zero, 30 pesos or $30 of interest? I could also have a decrease in taxes, you see, exactly for the product of the tax rate and the amount of interest. So the implicit interest that I am paying in the rent for a capital lease may be deducted from taxes, and that produces a tax shield. The problem with that is that usually I get told the rent, $115. You pay $115 per month in this lease agreement. But I am not told explicitly how much money I am paying on interest. I have to deduct it on my own. Okay? What do? An amortization table like this. I know how much money I am paying per month. I know the amount of money I am saving because I am not buying the photocopier or the car or whatever. Okay? I can run backwards the amortization table and determine what is the interest rate in a simulation, for example, that produces a value of zero at the end of the lease agreement. Having in mind that a lease agreement has payments in advance. So we usually make an amortization table for a credit starting in month or period one. For a lease agreement, the amortization table starts in period, year one, whatever, period zero. Because in period zero, remember, I am already paying. So in this rent, I am paying an interest. I don't know how big that interest is, okay, but I am paying interest for sure, okay? So I start with the value of the asset I don't have to pay because I will rent it. I know how much I will pay periodically, and I was working backwards, simulating with Solver. We will do this with Solver in Excel. I can deduct what is the implicit interest rate I am paying. With that, I can calculate the interest I'm paying every period. And these interest payments are the ones that produce the tax shield. So I need this amount of money multiplied by the tax rate to use it as the tax shield. Where is it? To use it as the tax shield in every period. Okay. Capital leases are, for valuation purposes, more troublesome. Okay. But I told you before, because we can capitalize the asset and because we have the option to buy the asset at the end, for companies that do want to have the assets, it is a very useful and attractive way of financing the purchase of an asset. Okay. Why is it attractive? Because there is no upfront payment. Compare this. This is a positive cash flow. What is a positive cash flow? It doesn't mean that the manufacturer is going to give me money, right? Or the lease company is not going to give me money. No. I am saving money. I don't have to pay anything upfront, and then I make small payments. Compared to the buy option, in the buy option, I have to make a very large upfront payment and fewer or lower later payments. But the problem is this one, for many small companies, right? I don't have money to buy 7 lorries. I don't have money to buy 10 motorcycles for delivering whatever I produce, okay? So I rent them, but I want to have the asset. Okay, I don't want to use it and then not have it. No, I want to use it and keep it. So a capital lease is a solution. All right. So for the financial lease, we have the lease payment, the depreciation tax shield, and the implicit interest tax shield. We net them, and we do the same. We compare these cash flow, the cash flow of a buy option. We arrive to incremental cash flow, and then we calculate a present value with those. On Wednesday, I will let you know what interest rate we will use for that. Okay? So far, so good?
Yes.
Questions or comments? Sure. You know, Thursday and Friday, there is a congress here in the school, Human Capital Congress, okay? I have not been asked to, but I am willing to, I will do it. I will cancel this Friday's class. That's why we didn't have a lab on last Friday, and I took it for listening, because I just don't want to get rid of time, right? So I am canceling this Friday's class. I won't ask you to sign a paper to make sure you went, but just, I know, and I feel the same as you feel. I have many things to do, but the school is making an effort. Okay, it's costing the school quite a good money, yeah, to bring these people, because the school pays for them. The school pays for the airplane, for the hotel, for all other travel expenses. Okay, people working, preparing the brochure, all the reservations, to have the auditorium ready. So we do invite you to go and listen to the conferences. It's half day every day. So half day on Thursday, half day on Friday. Okay. There is one thing I did not cover for dividends, which is the dividend irrelevance proposition 3 of the dividend irrelevance of dividends. So what I would do is, instead of having a lab on Friday because we are not coming to class, I'm going to ask you to make a summary of that paper. It's just a summary. So you just read it and summarize it. Okay. So I'm going to leave that as homework for this Friday up to the next Friday. Okay. That's something you have to study for your midterm exam. So it's not like wasted time. All right. So I just wanted to invite you to take a few minutes to invite you to go to the conferences. It is quite an important effort the school makes. We don't, we are not, having abundant amount of money here. So every peso the school invests, it's for you. They are doing it. We are doing it for you, mainly. Okay. So hopefully you can take the advantage of going and listen to the different people that are coming. 2 of your teachers are going to present their research. So it also will be interesting that you listen to Professor Valero and Ernesto Aguayo, because they are going to present there. Okay, so hopefully you will take the time not to come to class, but go to the conferences. Okay, so anyway, I'll see you Wednesday. Welcome. Thank you, teacher. You're welcome.
¿Quieren contratar?
Lo tengo en la oficina, vamos. Sí, dame porque no ¿cómo hacía algo? Sí.